Hi, this is James Eng with Old Capital, and today I'm going through a multifamily market update and financing update as of October 2021. Let's just jump right in here. So my background, born and raised in Houston, went to school at UT, been here in DFW since 2006. I was an underwriter for GE Capital for 8 years and then moved over to Old Capital where I've been focused on multifamily financing for the last 6 years, and then also invest as a limited partner in properties across DFW, Austin, and San Antonio. Let's just jump in here with sort of economic update to start. So we're seeing unemployment come down significantly from the peak. So 13% all the way down to 5%. But the bigger issue, if you've noticed when you go to a local restaurant, is there's a lot of job openings and not a lot of people who are filling those jobs. So we're seeing the participation rate drop from COVID. It's come up about halfway from the drop. And then we've seen the job openings surge. And so what that's leading to is inflation. So inflation is impacting wages, but then also supply costs. So we're seeing a lot of issues with getting goods into ports, getting goods all the way to you at your apartment. So if you're thinking about from the good side of the equation is your rents are going to go up with inflation, but then the bad side is that it might cost more to do those interior rehabs that you were planning and exterior items as well. So a lot of times we're looking at GDP and trying to figure out where is GDP headed, right? So we saw pretty much throughout 2010 all the way to sort of 2018, we stayed in that sort of narrow band of 3 to 4%. That big sharp decline in 2020 due to COVID. In 2021, we're seeing a big rebound. And then 2022, we're expecting more of the same for a couple of these reasons, right? So monetary stimulus, more things are opening up. I mean, here in Texas, things are pretty much already open, but across the country is a little different. So we continue to see a reopening. Consumer net worth, they received a lot of stimulus. So there's a lot of money in their pockets. And then as we continue to save more across the board, as more people have higher wages, as long as it's not eaten up by inflation, then I think they'll have excess savings as well. So this is what was a pretty interesting chart from RealPage, and it talked about the absorption. And absorption is really how many units are being leased in a market. And so you would love to see positive absorption every quarter, but that typically does not happen. But with this amount of sort of releasing of people back, a lot of people left their apartments during COVID and moved back home with their parents, or just moved, doubled up with somebody else because they maybe lost their job. In the second quarter, that really came all the way back and people started leasing units. We are seeing deals here in DFW where it might take, 18 to 24 months to lease up a new property. Those were leasing up in 8 months, so about half the time. So things were moving very quickly. And then this really shows, I think I've showed you this chart before, but I wanted to reiterate it sort of by market. DFW had the top amount of supply. So they had over 25,000 units, probably closer to 30,000 units. But then the second bar in teal, that was the absorption. And so that was how much was absorbed in that same period that the supply was delivered. So you would love to see that positive absorption every quarter over 12 months. And you pretty much had that across all the markets over the last 12 months, except New York. And so you're seeing that positive absorption, and that's really going to drive your rental growth. So rental growth is what, obviously a lot of investors are looking for. Sometimes it's forced appreciation. Sometimes it's forced through interior rehabs, but this is organic rent growth where, you're trading out a lease from one unit, maybe signed in 2019 or even signed in 2020. And now what are you signing those same same units for. And so on the left-hand side was Camden, and Camden, they managed close to 50,000 units across the Sun Belt. And, all across 2020, they pretty much had negative rent growth. And then in the second quarter of 2021, third quarter of 2021, they're seeing 10%, 20% on new leases. And Yardi was seeing the same thing. I mean, you essentially saw in 2019 all the way to 2020, essentially a flat rent growth. National was about 1,400, and then all of a sudden now, in 6 months, you've seen it go from 1,400 to 1,550 on a national average rent. They see that sort of cresting a little bit, but many properties, I mean, you're signing 12-month leases. Many properties are going to have a huge loss to lease right now as they roll those units over. And so rents have gone up significantly. And, if you do, cap rate math here on multifamily, just, $100 increase or $150 increase across your rent roll times 12 at a 5% cap, it's a huge, significant increase in value. And so that's what we're seeing across the board here, across the Sun Belt. So these are the markets where rent growths have really taken off. I mean, you see some of the, Phoenix is probably one of the larger ones that we've seen, whereas that rent growth has just accelerated north of 20%. Austin, 18%. Dallas Fort Worth is down here at 15%. But some of these rent growth, I mean, they're still expecting the rent growth to continue into 2022, but just at a slower pace. So closer to 4 to 5% in most of these markets. And this was actually an interesting chart I saw out of Yardi is, when you're looking a little bit further, right? So obviously the rent growth was good this year. Rent growth is expected to be good for 2022, but what's going to drive your demand for multifamily over the next decade? And, they looked at, all right, well, the 25 to 44-year-olds, those are still increasing. So you're still at 3.7 million in population change from 2020 to 2030. And then even though the demographic of 45 to 64 is going down, they're saying the divorce rate is actually a little bit higher. So that's creating more apartments, apartment renters in that demographic. And then also the demographic of 65 to 79, those people used to just stay in their homes, but a lot of those people are moving into apartments. We're seeing a little bit more of that. And so that demographic is increasing by 10 million people. And so all these demographic favors multifamily over the next decade, for sure. And so when you look at demographics, you're saying, all right, that is going to help us in terms of demand, absorption, and then where are those people going to go though, right? In terms of locations, in terms of cities. So almost everybody's going to cheaper living in terms of where they're going to go. So a lot of migration, net migration into Phoenix, Dallas Fort Worth, Austin, Tampa, Charlotte. Those were sort of your top metros, and then the expensive gateway cities is where they're seeing the net migration come out of. This is always one of those things that always concerns me is like as more and more people work from home, what is the risk to multifamily? And Yardi did a good analysis around this and just sort of looked at, all right, how many people are in the office? And let's say 25% of those people end up not going remote instead of coming in. And how does that impact sort of the number of renters versus the multifamily stock? And it is just a bashing of the top markets. So LA, San Francisco, New York, Chicago. So all your coastal markets are having issues, whereas, the, cheaper metros with a little bit more spread out workforce, and maybe in your B and C properties, all those people don't necessarily work from home, right? So, maybe it's the teachers or the nurses or, industrial jobs, like people just have to be there and they can't work from home. So a lot of the office using employment is going to be impacted a little bit more here. So that's driving. So we've seen the migration, we've seen the work from home impact, and just the overall pricing of deals. And so you can see it in the number of sales that have happened and where the money is moving, right? So you you can see a lot of money moving into Dallas, Atlanta, Phoenix in terms of change of sales volume from 2019 to 2020, and it's coming out of the coastal markets. And then there's so much competition in multifamily. People are saying, why are we still buying multifamily? Cap rates have continued to come down, and it's all relative, right? So if you look at this chart, this is your yield spread between 10-year treasury, which is sort of your risk-free rate, versus cap rates, right? So multifamily cap rates, I would say on average about, let's say 4.75 is what they're using here from Newmark. You know, depending on the market, it might be even lower. And the spread, I mean, you go back and look at the spread in 2007, 2008, your spread was under 100 basis points between your 10-year treasury and your cap rate. So you can look right here, and it still is sitting at 300 basis points. So you still have that positive spread, that positive leverage. And once we get into the financing, we'll see sort of, okay, 10-year treasury is 145, but what am I borrowing at in terms of loan interest rate, and then comparing that to your cap rate, because you want your interest rate to be lower than your cap rate that you're buying at. All right, so these are really the 5 loan options that are out there. We're going to dive into each one and spend a little bit of time on what's going on with those particular ones and how multifamily investors are using those loans right now. So just at a high level, the bank loan is really where most people start. This is really for loans under 5 million. Freddie Mac SBL goes up to 7.5 million. The minimum is $1 million. And then Freddie Mac conventional, Fannie Mae, those are going to go from $1 million all the way up to the max, as big as you want to buy, really. And then non-recourse bridge starts at about $5 million. So we're going to talk about each one of these in a little bit more detail. All right, so let's just start with the agency lenders. So the agency lenders are really these 3 in the middle. So Freddie Mac SBL, Freddie Mac conventional, and Fannie Mae. So in the second quarter of 2020, they did 40 billion in volume. In the second quarter of 2021, they did 24 billion. So about a 40% drop in this, really driven by non-recourse bridge. So we're going to talk about non-recourse bridge, but non-recourse bridge lenders came in very competitive. And so they were higher leverage and essentially the same interest rate. And so a lot of people were going with non-recourse bridge. Just the last week, Fannie and Freddie announced that they are going to increase their caps. So they had 70 billion each this year, and now they're going to go to 78 billion. And they're going to look for a little bit more affordability in their in the properties they finance. So that's good news for the multifamily industry, because it's you're not Fannie and Freddie are a huge resource for stabilized properties for people just getting in the business. Maybe you're not trying to have a huge heavy value add. Fannie and Freddie are your stabilized lenders, so it's great news to see that in 2022 they're going to keep lending and their caps increased. So if you're going to say in 2021, what was it the year of? It was the year of the non-recourse bridge. This quarter across Old Capital, probably 75% of what we do this quarter will be non-recourse bridge. And so it's more of a flexible transitional loan type. So it'll be 3 years, usually initial term. Then it'll go 2 one-year extensions. It can go up to 80%, and then it has a 1% prepay. And so what we're seeing is the number of bridge lenders in the market continues to increase this year. So at the beginning of the year, there might have been 5 to 10. Then middle of the year, there was probably 20. And now towards the fourth quarter, what we're seeing is that these bridge lenders are essentially full with the number of deals. So people with even Fannie and Freddie licenses there's only 10 to 15 people who have Fannie and Freddie licenses. And that is a very special license, yet they're still doing more bridge loans. So there's more bridge lenders out there, but then also that is what the market is demanding based on where these prices are going. So we talked about where the rents were at the beginning, let's say February of 2021, and where they are now. And that is driving a lot of these people to still buy properties, use a bridge loan, get the rents up to market, and then refinance to Fannie and Freddie. All-in rates for bridge loans, it continues to go down. I would say this is segmented a little bit by loan amount. So if you're, I would say, under 10 million, you're probably in the 4s, low 4s. If you're above 10 million, maybe even 20 million, the higher the loan amount, the better pricing you're going to get. So I would say low threes for anything sort of 20 million and up. And then in that 10 to 20, you're probably around 325 to 3.5 over LIBOR. All right, so this is some of the things that they're looking for. So they're still quoting it over LIBOR, most bridge lenders. So you'll buy an interest rate cap. They're looking at your experience, what the rehab plan is. And then this is the big thing. They're looking at your debt yield. So they're looking at your NOI divided by your loan amount. Most bridge lenders sort of by year 3, they want to see a 7, even an 8% debt yield on your pro forma because they want to be able to exit the deal, right? So exiting the deal means you selling the property for more, or you're able to refi with Fannie or Freddie. All right, so here's an example of why sort of non-recourse bridge is ruling the day right now. So let's take a $30 million purchase. There's Fannie fixed, there's Fannie float now, there's Freddie. Essentially, all those are going to be 60 to 65% in today's market. Here in DFW, that's what we're seeing on a lot of deals. I would love for it to qualify for $23, $24 million, but Fannie and Freddie are still looking at the T3. And so they're looking at net rental and they're using that number for their underwriting. And so that's limiting how much loan dollars they can give. If some of those rents start translating into the rent roll, then and they have a good T3, then maybe this leverage could go up, which will help Fannie and Freddie. But right now, non-recourse bridge lenders, they're looking at year 3 pro forma. And so when you're looking at year 3 pro forma, that allows you to get 75, 80% of purchase and 100% of rehab. And the rates are in that 325 to 3.5 over LIBOR right now. All right, so some of these are the items that you're going to need on the bridge side. Your standard T12 rent roll OM, but we're going to need your CapEx, your pro forma, sort of your track record, and then any sale comps to support sort of where you're going to take this deal. So those are some of the important things that you're going to need on the bridge side. All right, here's an example of a deal we recently closed, 236 units over in Fort Worth. So we did 75% of purchase, 100% of rehab, 3 + 1 + 1, LIBOR plus 325, and a 1% prepay. So the seller had done majority of the exterior work on this deal. The goal was for the new buyer to come in, do the interior rehabs, improve the rents, and then refi to Fannie or Freddie or sell the asset at that point. All right, let's move over to Fannie Mae. So Fannie Mae starts at $1 million, goes up to $100 million if you have a big enough deal. Right now, the biggest change really is that the floating rate loans are available now for Fannie Mae. So above 15 million, they'll take a look at those. And we're seeing a lot more flexible prepayments. So people are taking, if they're more comfortable with fixed rate deals, they're taking it, and especially if you can get the leverage, right? So if you're at 70% or 75% on Fannie Mae, let's say on a smaller deal, we're still seeing a lot of Fannie Mae business, and they're taking either a step down prepay or a 10-7, so 7-year yield maintenance, but fixed for 10 years. So here's an example of where interest rates are going. 10-year treasury has run up a little bit, so it's closer to 1.5, 1.6 right now. And that is driving this interest rate movement from the beginning of the year. So beginning of the year, 10-year treasury was a lot lower. It's probably 40, 50 basis points lower. And so that's moving these interest rates up on the fixed rate side. So, depending on if you take yield maintenance, so this is a standard yield maintenance, you're at 355. If you're at a step down, you're 394 on a $7 million loan right now. So here's a non-recourse Fannie Mae loan that we did. So 224 units. We did a 10-year loan, so it's fixed. We got 5 years IO and then 7-year yield maintenance. So this one, we were able to size closer to that 65, 70. They didn't want the interest rate risk. They didn't want the interest rate cap cost. And so they went with just a fixed rate and set that deal. In terms of reserves, there's no reserves on conventional multifamily, but student and senior are still going to have some reserves on your Fannie Mae loans. All right, Freddie Mac conventional, this starts at 7.5 million. And, they have fixed and floating. This is for a little bit more experienced investors. The big thing on this one is every deal's got to go to Freddie for approval. And so you want to get the deal pre-screened, and then you want to build in a little bit more time. I would say a 60-day close plus at least one 15-day extension will be pretty good. In terms of rates, they're in that high twos. So you're maybe 285 to 290 right now on rate, and they are quoting this over SOFR. So this is on your floating rates. And so I wanted to dive in a little bit on, a lot more people are doing floating rates. So you have to understand sort of what the risk is on a floating rate deal. And, a year ago, most people were projecting LIBOR to be about 1%. And, they had a projection for SOFR too, but SOFR was relatively new, but it was essentially flat and followed LIBOR. And so when everyone's expecting LIBOR or SOFR to be 1%, 8 years from now, then the interest rate caps are very cheap, right? So if you buy a 1% cap these first 3 years, that insurance company is saying, like, I'm not going to pay out on this deal, so it's pretty cheap. But now if you look at, all right, this was last week, I pulled it. Look how fast they're expecting LIBOR and SOFR to come up on these forward curves. So in the next 2 to 3 years, they're expecting LIBOR to hit 1%. And if your loan is based off a spread over LIBOR, you could be increasing your interest rate by 1%, 2% very quickly. And so what lenders are requiring is you have to buy a cap right here. So you have to buy a cap. You can choose 50 basis points, you can choose 1%, you can choose 1.5%. But the closer you get to your strike rate and that line intersecting, the more that's going to cost, right? So we'll pull up some, here's a couple of LIBOR caps and SOFR caps, but essentially in the first 2 years, it doesn't cost you much, right? So it might be $25,000. This is an $8 million loan. It might cost you $25,000 because in the first 2 years, they're not expecting it to really hit this 1% level. But in that third year, all of that is coming. So you can see between the 2 year and the 3 year, it's almost 3 times the cost. So you have to make that call as the investor. Do you want to just set the deal right now? Usually Fannie and Freddie require 3-year minimums. Some bridge lenders are more flexible, so talk to your bridge lender. But Fannie and Freddie want 3 years on theirs. And then, if you go out even further, the interest cap cost is pretty much doubling every year after year 3. So it's doubling from 125 to 280 to 450 on this $20 million SOFR interest rate cap right there. So here's a non-recourse Freddie that we closed earlier this year. It was floating 287 over SOFR, so less than 3%. They were able to get to 70% LTV, so it wasn't that much of a difference between, in terms of leverage, they had a little bit more equity they had to put down, and similar terms, 5 years IO, 10-year term, 30-year AM with 1% prepay. Currently, there's no reserve requirements on Freddie conventional, so you're in good shape there. So a lot of people are coming to me and saying, all right, what's the difference between, all right, if I do a fixed rate, if I do, or if I do a floating rate? Let's say this is just on Fannie Mae. And here are the different options, right? So you have a 9.5-year yield maintenance, you have a 7-year yield maintenance, you have a step down, and you have a 1% prepay. And, with the fixed rate right now, your starting rate is going to be closer to 3.5. On the float, you're going to be closer to 260, 270 on Fannie Mae. And so when I looked at them, I said, all right, your total interest rate cost on the top, and then your prepayment, right? So if you have yield maintenance and you exit the deal, let's say in year 3, your total interest cost plus your prepayment cost for this first option, option 1, is going to be $4.7 million. Okay, but then let's say on your floating rate, you're going to pay interest cost here. I assumed you buying a 1% cap, interest cost of $738,000 a year, but then your prepayment's only 1%. And so in year 3, when you exit, that's 2.7 million, year 4, 3.4, and year 5, 4.1. And so essentially in the first couple of years, as long as you buy a cap and your interest rate stays and you exit in those first 5 years, you essentially come out better on a floating rate deal. The way this is currently structured in this example, you have to run it specifically for your property. But then, if you hold the deal a little bit longer, So let's say we hit a recession, year 3, year 4, and now you have to hold the deal into year 5, year 6, 7, 8. That's where it becomes a little bit dicier because you're going to have to go out and buy an interest rate cap in year 6 or refinance the deal. And then your interest costs are actually higher year 6, year 7, year 8, and the fixed rate actually is better for you. So that was just one example. I ran this analysis for one of the clients that I was working with, just to give them an idea of, all right, depending on your hold period, if it's, year 3, year 4, the float might make sense. But if it's year 5, year 6, then your fixed rate might make more sense. All right, let's talk about Freddie Mac SBL. So this is $1 million to $7.5 million. So this is still a viable option for a lot of investors who are buying smaller properties. This is based on 10-year Treasury. 10-year Treasury has gone up a little bit. It's closer to 1.5 right now. And so this was a deal that we closed about 2 years ago. It was a 75% LTV, 7-year term, 2 years IO, 30-year AM thereafter, and with a step down prepayment. So this will give you an idea of it's stabilized property, but maybe there's upside on rents because rents have gone up significantly. And so you can buy it with Freddie SBL, and then it has a softer prepayment, the yield maintenance. And then you can get a 5, 7, or 10-year term on non-recourse Freddie. So here's sort of pricing right now, anywhere from 3.5 to 375 with a step down, and they still have reserves, right? So their reserve structure right now is still on acquisitions. You're going to do 6 months of your debt service, and then if you're doing a cash out refi, it's 12 months of debt service. And so it usually is going to be in place for about a year, and then they're going to release it back to you. So here are some of the loans that we've recently closed, just to give you an idea of what we're closing out there. Hollyoaks, Uptown at Cole Park, those were both non-recourse bridge loans. Century Oaks was a Freddie Mac conventional. Ranch at Joyce Lane was a recourse bank loan. Diamond Lock we talked about earlier, Freddie conventional. Villa Gardens was Fannie Mae on Courtyards, and Heritage was Freddie SBL. So as you can see, we as a mortgage broker at Old Capital, we're going to look at all the different loan options out there, right? So we're going to look at Fannie, Freddie, Bridge. We potentially could look at CMBS or HUD or construction and help you through that. And so, what I like to say is that we sort of at the beginning educate you, connect you to the right people, right? Whether it's listing brokers, property managers, and we're going to advise you during the process about what best loan to take, and then help you close that loan. And so this was just a summary of us versus other mortgage brokers or other lenders out in the market. So here, we're just going to wrap up. So I appreciate everyone watching. If you could subscribe to the channel, that'll get you updates on when we release new videos. And then also, if you need help with a loan term sheet, that is what we do. So send me T12, rent roll, OM, the whisper price on the deal. We'll put it together and figure out, a term sheet for you and give you feedback on that deal. If you're reviewing a deal, let's say as a limited partner, and you're thinking about, hey, should I invest in this deal? Happy to look at any of those deals and talk about the investment package with you. And then really to start, the first thing that we ask people to do is complete a personal financial statement, and then we'll set up time to talk and discuss sort of buying, selling, refinancing your next multifamily deal.